All right. Hello, everybody, and welcome to another podcast with Investing Education Academy. You have myself, Brent Simpson, along with the co founder, Leon Noble. Today, we're going to be talking about some stocks that you want to know more about. Leon's going to tell you what the stocks are, why we chose them, while I do a little bit of housekeeping.
Yep. So today we're going to we'll talk about why we think now is a good time to get into banking stocks. And I'm kind of go down the path of why. So some of y'all might remember March of last year, 2023, there was a big bank failure in Silicon Valley called Silicon Valley Bank, or SBV. This was a huge deal for like the startup world because literally, and I'm not exaggerating, 99.99% of all the startups in Silicon Valley had the lion's share of their startup funds deposited with Silicon Valley Bank. And so when Silicon Valley Bank failed, March of last year, there were people in Silicon Valley literally saying this is what they call, quote unquote, called an extinction level event if Silicon Valley Bank was not saved, because all those tech startups we love and talk about all the time in Silicon Valley were going to go under. It was going to be a massive, massive hit to the local economy in California, and probably could have been, for the large U.S. So Silicon Valley Bank failed, and then there were like two to four after that also failed. I think there were like two in New York, and it's kind of
Well,
a cascade.
Leon, they had a bank run. They didn't actually fail
No, no,
because
no, no.
they were
Well,
saved.
that were two different things. Yeah, there were bank runs on other banks, but like
Oh,
two to
yes.
four other banks also failed. Yes, yeah.
Yes.
And
But
and,
not
and,
Silicon Valley Bank.
what do you mean?
They didn't fail. I mean, they still exist. For some people, they may hear fail and think they don't exist
Yeah,
anymore.
well, yes. Well, they literally did fail, but
Yes.
but Federal Reserve came in and propped up essentially the banking sector. So Silicon Valley Bank, let's just say, effectively failed. It
Yes.
was saved by the Fed. There were two to four other banks that failed, a couple in New York. But again, the Fed came in and actually, I think, don't quote me on this, but some of the big banks actually bought some of these smaller banks,
Yes. Yeah, I
so they
heard
wouldn't
that
fail.
too.
Yeah. So basically, what happened? The banking sector was in turmoil in March of 2023. If you go back and look at a lot of the charts, a lot of the stocks, um, they fell. I mean, so the industry alone fell 20%. So generally, most banking stocks fell a minimum of 20%. Some of them were down almost 50% in March of 2023. Now, you know me, I'm a guy who loves the old pullback in a stock, but I don't I don't, as they say, chase falling knives, right? So when that happened, I was like, okay, this is only this. There's a the reason they failed was based on interest rates. I'm not going to go down the whole path, but it had to do with the bonds on their balance sheet and kind of some mispricing. It's a lot of wonky talk, but they failed basically because of interest rates being really, really high and going up at a fast rate. And so it was kind of a unique it was a unique thing. It wasn't like the economy was failing. It wasn't like these banks had bad their customers are going away. It was strictly based on this whole their whole bond portfolio. So I looked at it like, yo, this is an opportunity because the mispricing is based on one small event, not like an industry wide thing. But like I said, I don't like to catch falling knives, so I like to see something come down and then start to recover. So March 2023, the banking sector, was generally most banks, they dropped by 20%. March 2023. Now, up through today, since March of last year, the banking sector is up 56%. Right, so banks crashed, but like as we all know, especially people that are following us, if it's all about time in the market, not timing the market. So anybody that was in those stocks at the time, if you just held on, yeah, it was painful, but the market came back. Now
Oh,
I've been
and
eyeing the
Leon,
bank. Oh, sorry. Go.
well, real quick, for some of you all who are, like you heard that statement, it's about time in the market, not timing the market. We have gotten emails, we've gotten comments. We understand that, yes, some day traders have had some success for now. Yes, we understand that some people flip stocks or you're trading penny stocks. Yes, we know that. However, by and large, your time spent in a viable investment that makes sense, that's growing systematically, makes more sense than trying to time the hour, the seconds, counting pips to when you get in and when you get out. Like, it by and large, you're going to win picking quality stocks that are going to grow over time versus trying to track a stock by the minute, by the day, or whatever it might be to get in and out.
And yeah, anyone who says that they're a day trader, and like Brent said, there are some successful ones. We're not saying there aren't, but those people sit in front of their screen all day, every day, 24 hours a day,
or they're glued to their phone, or
yeah, they're glued to, right. Like it's a high octane, like highly stressful thing. Most of us have lives, like families, jobs, parents we take care of, whatever.
Places to ride your bicycle.
Well, yeah, just go outside and run your feet through the grass, like living life, right? So that, a certain sector of people, yeah, they do enjoy that sort of day trading. But for the most of us, like Brent said, by and large, we don't have time for that. So it's about buying quality assets and letting time work for us. So like I said, March 2023, the banking sector dropped by 20%. Some stocks were down closer to 50%. And since then, the sector has recovered by 56%, which is great, right? And that's why now we're kind of interested in it, because you never want to buy something when it's going through turmoil. You want it to prove itself that it's back, and then that it's a viable industry again. And that's where banks are. Banks historically, like most companies, follow the economy, right? So as long as the economy is strong, which right now we have a very, very historically strong economy, banks are doing very well. So earnings season, when companies report their earnings, banks always kick it off. The big banks, JP Morgan, Wells Fargo, Bank of America, HSBC, all of them reported a couple weeks ago, and all of them either met or surpassed Wall Street's estimates, right? So the banking sector is doing awesome right now. And then a lot of them have actually raised guidance for the future, saying they're actually going to do better than Wall Street thinks. So that's really the premise for this. That's why we like banks now, because one, the economy is doing well. It's very, very strong. And banks went through a really, really rough patch a couple of years ago, or a year ago, almost a year and a half ago, and now have come back and are really really strong. And just kind of a point of a comparison. So I didn't look this, so I looked at this morning. The banking sector is actually outperforming the S&P 500 right now. Not by a lot, but it's outperforming. So the S&P is our benchmark, right? Right now, the S&P is up 23%, while the banking sector in general was up 25%. So it's outperforming by 2 percentage points so far this year. I did not know that. I knew it was doing well, but I didn't know it was actually beating the benchmark, which is really strong. Last main point is that Brent and I probably most people watching this are pretty heavy in tech stocks, because that's what a lot of the juice is in the market. Bank stocks in the banking sector is actually not as correlated to tech stocks as other sectors. So the reason that's important is because if you have a day where tech stocks, and we all know this can be down 3 to 5%, bank stocks will not follow that. Bank stocks may be down like 1%. So the correlation between bank stocks and tech, they're pretty much almost uncorrelated, not negatively correlated, but uncorrelated. So it's almost like a hedge for you if you have a portfolio that's heavily weighted towards tech.
Leon, when you say hedge, what do you mean by hedge?
Hedging is just it's almost like a way to secure your portfolio against volatility. So again, if you have a highly portfolio that's heavy in tech, it's typically going to be more volatile, right? So if the market's down, say 1%, generally tech may be down 2 or 3%. Well, if you also have some bank stocks, again, the market is down 1 or 2%. Bank stocks may only be down like half a percent, maybe 1%. So they're not going to just like crash or tank as we know tech stocks do. They can add a little bit of buffer to your portfolio, and hence the word hedging. You're kind of putting a bet in place that's gonna like I said, buffer or pad your portfolio some and get you good growth, right? Because again, right now, bank stocks are up 2% more than the general market, which is really good. So I like the fact that one, they've rebounded from their trouble last year. The economy is strong. Banks are going to follow the economy. Close to that, probably most industries. And 2 and 3, they're not as tightly correlated to tech stocks. So those are 3 reasons to look at bank stocks right now.
Yeah. Also, too, you got to think as we're in a lower interest rate environment, banks are going to get more activities from people trying to get bigger in products like homes, cars, things of that nature, business loans. Is people just have a higher propensity to go for leverage money, which means money they're borrowing, than they would if it was a higher rate environment, because essentially the money costs more. So, as we go towards a lower interest rate environment, banks will be getting more customers, to put it very simply. So I think that's another thing to kind of think about.
And one on that point, so banks are saying, so remember interest rate. So right now, most people in this country that have a 30-year fixed loan, their mortgage rates are typically below 4%. Like people have really, really low rates. So what people are doing is they're not necessarily looking to buy new homes because currently mortgage rates are like 7%. What they're doing is they're refinancing. And so that refinancing, these banks that hold these mortgages are going to get a lot of refinancing activity, which again is more revenue for the banks. It's more business for the banks. So to Brent's point, that with interest rates coming down, banks are going to see a lot more activity around their mortgage portfolios.
Yep. So I mean, these are all things to consider when you're looking like, well, why should I buy bank stock? And let's talk about it this way. Most of us have our money in the bank. So the question is,
Right.
are you part owner in the bank that you host your money with? They have your money anyway.
Mm-hmm.
They're going to be making money off your money. Like, are you part owner in their company because they're part owner of your money? So, let's level the playing field a little bit. And Leon and I, we did a podcast earlier when we were talking about credit cards. And during that podcast, we talked about the fact that we own many of the credit card companies we own pieces of. And so just think about it like that. Like, are you supporting or are you making money off of the bank that definitely is making money off of you?
Mm-hmm. I mean, it's the old adage, which I don't necessarily subscribe to, but it makes sense in that, buy what you own. Sorry, buy what you own. That makes sense. Buy what
Own what you buy, where you buy, where you spend your money.
Where you shop. You should, like, if you go to Starbucks every day, you should probably own some Starbucks. If you go to Home Depot every day, you should probably own some Home Depot. Now, I'm not saying I'm not saying that's a reason to buy a stock, but it's a reason to like investigate a stock, do your research, that sort of thing. But yeah, it's like Brent said, we own a lot of the credit card companies and some bank stocks because again, we don't own them because we shop them or use them, but that's another reason to own them, another reason to investigate these companies because you're already using them. They're getting your money anyway. Maybe a good investment.
Yeah. So for everybody who's with us today, thank you for being with us. Thank you for continuing to listen to our podcast. We're hitting somewhere around 5,000 plus unique downloads per month, and the numbers climbing. So thank you for that. And share it. Share the podcast. You can go to iapodcast.com. You can listen to past episodes. Do some research. When you hear previously, we used to list the stocks that we were, suggesting that you look at. Pull up a chart and look at the year of the podcast. Check what that stock's been doing up until then. Some of them we sold, some we held on to. But I think it's just fun to kind of go back and revisit those thoughts. Also, if you've been kind of considering joining Investing Education Academy, now's a great time to do it. You can go to iamembers.com, become a member. We're moving into an election like next week. So a lot of people are trying to figure out, what am I going to do with my money after this election? Like, does it matter where I put it? Should I change things? Should I not change it? Should I leave it the same? These are things that, people are curious about, and we can have those discussions inside the platform. So please join us there. If you want to dip a toe in the water, you can also go to our Facebook group. But, our membership community is where the bulk of action occurs, and it's where we have our deeper conversations. So
one other point is that also you can just search Investing Education Podcast on all the podcast platforms.
Yes. And if you don't see it, send them an email and say they need to have it. So you can always send an email and ask, why don't you have it? But we should pop up.
Yeah.
So for that, we owe you all 2 stock picks. They will be inside of our Investing Education Academy community group. And other than that, we'll see you there. Everybody have a good, rest of the day. And we look forward to you listening to us on the next podcast. Have a good one. Bye.